Hello, everyone. Thank you so much for attending this presentation. My name is Jody Zellner, Financial Advisor, CPFA, and President of Safe Harbor Financial Advisors, Inc. Today, we're going to be talking about preparing for retirement. Here are the general areas we'll cover in today's seminar. Where to start, your income and expenses, Social Security and its role in your retirement plan, how much money you will need, and finally, we'll go over all these things and come up with a plan to see if you're ready to start retiring. First, let's talk about how to get started. One way to start is to start asking yourself questions about what your retirement will look like. Where will you live? What will you do? How much money will you need to do that? How much money do you currently have? And very importantly, and not talked about enough, what are the health related issues that I'm going to have in retirement? Having read these questions, I'm sure you have thought of several others that are more specific to you. It's a great idea to start a file as an organizer for retirement. Keep these questions, answers, and other information you collect in it. One of the first things you should do with any financial goal is to create a budget. A budget is basically a spending plan. It takes into account all of the income you expect to receive and allocates that income to specific expenses you expect to have in the coming months. The budget shows us where our income goes. It identifies the specific expenses we'll face and how much we'll need to be able to meet those expenses. The spending plan can help achieve financial goals by controlling those expenses. That can potentially result in your retirement savings lasting longer and help you work toward financial security. Now let's take a look at some of the advantages of having a retirement plan budget or spending plan. A spending plan empowers you to take control of your finances. You'll have the tools and information you need to decide exactly where your retirement money is going to go. At its most basic, a spending plan divides income and expenses into useful categories. But in addition, the plan provides further organization by automatically keeping a record of all your financial transactions. It also sets the stage for a useful, simple filing system to organize all bills, receipts, and bank statements. When your spending plan is operating, all your financial transactions will be automatically organized at income tax time. Best of all, the top reason for having a budget or spending plan is that it will almost certainly produce extra money. Unnecessary expenses, once you've identified them, can be eliminated. Savings, even small ones, accumulate. With a spending plan, you can put those savings to work for you. In order to have a good budget or good savings plan, you'll need to be very specific about your income and expenses. So let's identify the key types. Okay, now we're going to talk about those income and expenses. We're going to start off with expenses. Unfortunately, there's usually many more categories of expenses than there is for income. To make it easier to think about all of your expenses, break them down into those that are fixed and those that are variable. So what is the difference between fixed and variable? Fixed expenses are those that don't change over time. For example, your monthly mortgage or rent, or your auto loan, or your life insurance, or your auto insurance, or your student loan payments are usually fixed. Variable expenses are those that can change from month to month. Some examples might be food, medical expenses, auto repairs, telephone, utilities. We don't know what we're going to pay each month for those categories. So let's look closely at the fixed expenses you'll need to include in your plan. When working on your list of fixed expenses, think about property taxes or quarterly estimated income tax payments, your mortgage, including escrow amounts for insurance and taxes or rent, the amount you pay for water, electricity, gas, cable, TV. Now, these can vary from month to month, but sometimes you have the option of fixing those payments. Insurance, this might include life insurance, homeowners insurance, car insurance. Be sure to include any monthly car loan or lease payments you have. Student loan payments also fixed. You'll likely have many more variable expense categories than fixed ones. These are expenses that can vary from month to month. If you see below, some of these can include food, clothing, furniture, gas and oil, entertainment, medical care, gifts, vacation, personal items. These are things that don't necessarily come up each month, but they certainly vary in expenses from month to month. Now let's talk about the income portion of your budget. Let's think about all the sources of income you will have during retirement. You might have earnings from a part time job or start your own business. You might have annual distributions from an IRA. You may have a pension income from a previous job or military service. And of course, at some point, you'll want to begin taking withdrawals from your 401k account. And don't forget about interest on your savings account, any income from your money market funds. You may also be receiving dividends from stock that you own or from mutual fund investments. And finally, you will want to take into account your expected Social Security benefit. Taking a look at last year's federal income tax return should help you quickly identify the sources of your current income. Ideally, when you're done with your budget and you get to the bottom line, you're going to hope that your income is more than the total of your expenses. That's the ideal result. It probably means you're going to be able to live within your retirement income. More importantly, it indicates that you probably have opportunities to put that excess income to work for you, such as increasing your savings. But it's entirely possible that your expenses might be greater than your income. If that is your result, you're going to have to look at harder places to cut, examine increasing your income, or maybe even consider working longer and postponing your retirement. Regardless of the bottom line you reach, when you do your initial draft budget, you'll have a much better handle on the financial situation you're facing during retirement, and you'll be armed with the detailed information to use in adjusting your income and expense projections. Other than income and expenses, we also want to look at this as sort of an assets and liabilities, basically a way to calculate your net worth. Keep in mind that you're concentrating on assets in this case, not income. Assets are any financial or material possessions that have monetary value. Assets might include cash in bank accounts, stocks, bonds, mutual funds, annuities and retirement plans, life insurance if it has a cash value on it, your home, your car, your boat, your RV, household furnishings, jewelry, books, coin art, any kind of collectibles. Remember that your assets are valued at their current market value, not what you paid for them or what you would hope they would sell for. Next, we'll take a look at your liabilities. Liabilities are financial obligations or debts you owe to others. These are things like mortgage, your car loans, your credit card debt, your taxes, your major unpaid bills, any personal loans you have. Unlike expenses which track your liabilities, how much you're paying them off month to month, when you're tracking your full term liability, you want to know what the net liability is, how much you still owe on your mortgage, not what your monthly payment is. That would be under expenses. Once you've subtracted your liabilities from your assets, that amount, hopefully positive, would be your net worth. So, why would you calculate your net wealth? Well, net worth can be helpful for a lot of things. Applying for a loan if needed, preparing your will and knowing where the assets go, determining your insurance needs if needed it. But more importantly, it's going to be seen as a progress towards your financial goals. Your net worth is just an indicator of how you're doing in terms of working towards those goals. For example, if you look at your IRA or 401k plan balances, you would get a good idea as how far you're doing as far as making sure that you have assets that you won't outlive in retirement. Next, we're going to talk about the always in the news Social Security benefits. As of today's laws, you can begin receiving individual Social Security benefits anytime between the ages of 62 and 70. Your benefit amount will differ, however, based on your full retirement age. This is based on the age of your birth. For example, you'll see in this chart that a person born in 1948 has a full retirement age of 66. This means that he or she will receive 100% of his or her benefit based on the credited earnings and Social Security tax paid at age 66. For someone born in 1960 or later, the age for full benefits is 67. Let's see how starting to receive full benefits early affects this amount. Starting your benefits early means any time between the ages of 62 and your full retirement age. The early retirement age reduction at age 62 ranges from 20% to 30% and is based on your birth year. For example, let's say you were born in 1950, qualify for a monthly benefit of $1,000 at age 66, your full retirement age, and chose to begin receiving the benefit at age 62. You would only receive $750 due to a 25% reduction. In this example, if you waited to age 63, your monthly benefit would be reduced by only 20%. At age 64, it drops to 13.33. At age 65, it's 6.67, and then you get to your full retirement age where you get 100%. Those who need the income right away, taking benefits early would be appealing, of course, but the benefit amount is permanently reduced once you've made that choice. You can also go the other way and delay your Social Security. If you wait until after your full retirement age to start receiving Social Security benefits, your benefit amount will be increased. For someone born in 1943 or later, his or her benefit is increased by 8% for each full benefit year they are delayed after reaching the full retirement age. So the longer you wait, the higher your benefit. And remember, if you work past your full retirement age, more earnings are added to your Social Security. As a result, if your lifetime Social Security earnings are higher, your benefit may be higher in addition to the delay factor. Will your benefits be subject to federal income tax? So that question is a little bit harder to answer. Yes, your Social Security benefits can be taxed or can be subject to federal income tax if your combined income is above certain levels. As you can see from the examples below, whether single individual, if your combined incomes meets those certain level, your Social Security income can be taxed in that given year. Another question I get is, can you receive Social Security benefits while you're still working? The answer is yes. However, there's a limit you can earn before your benefit is reduced. For 2025, that limit is $23,400. It is adjusted annually to reflect inflation. This limit applies only to full retirement age when it goes away entirely. Let's look at an example. Assume a person is 62, is receiving benefits, has a retirement age, full retirement age of 66, and earns $23,880 a year. In his or her 2025 annual benefit would be reduced for $1 for every $2 over his or her earnings that went over the limit. In this example, the earnings were $480 over the limit. So the result would be a reduction of $240 to the annual benefit. There's a much higher limit for the year in which you reach full retirement age. Also, the reduction for that year is $1 for every $3 in savings. Obviously, the earning limits is a key factor to consider between the ages of 62 and your full retirement age. The good news is that the earnings limit no longer applies at full retirement age as of today. There's a lot to think about regarding Social Security benefits. I'm sure you agree that the topic needs to be at the top of your list when planning for retirement. There's also very helpful information as well that you can find at the Social Security Administration's website, www.ssa.gov. When you've made that decision and know when you want to apply for your Social Security benefits, it's helpful if you bring the following items: your Social Security card, information about your home or where you rent, things such as a mortgage or your lease, tax return or W-2 forms, proof of U.S. citizenship, and your checkbook so you can have your Social Security payment deposited into that account. Remember, you should apply for benefits about 4 months prior to actually wanting them to begin. So now that we've talked about income and expenses, assets and liabilities, and Social Security, let's talk about the big thing. How do you figure out exactly how much money you may need in retirement? So many financial experts are going to suggest you need anywhere between 75% and 90% of your current annual income to live comfortably in retirement. I'm going to tell you that really depends on how you want to live in retirement. So you really do want to talk to your financial advisor about that. But one thing you want to take into is first off, how much will Social Security contribute to that amount? For the average person, Social Security may replace about 30 to 40% of the wages that a working person earned before retirement. You can check this out by going to the Social Security website, www.ssa.gov, and apply for online benefit statements to see where you stand. You can also use one of their interactive calculators, which will give you a rough estimate of what you can expect in Social Security benefits if you don't want to go through the process of seeing your actual statement. However, I do recommend seeing your actual statement as it will give you a much better idea of what you're going to collect in retirement with Social Security. So now that we've talked about Social Security and the role it plays, making between 30 to 40% of the income of the average person, once again, talk to your financial advisor to get a better handle on your expenses. You'll need to calculate how much more money you will need in addition to that Social Security to live comfortably. Unfortunately, one of the things you're going to have to take into account in those calculations is inflation. Inflation is the rate at which the general level of prices for goods and services is rising and purchasing power is falling. Unfortunately, in retirement, you will probably be living on a fixed income. However, the cost of basic essentials will likely continue to rise. This is a loss of the dollar's buying power over time and can have adverse effects on the real growth of your retirement account. So be sure to maintain a proper mix of investments in an effort to offset that inflation. Also, make sure to take into account that inflation, when you look at your average expenses in retirement, is going to increase those expenses. Another thing you want to take into account for is how many years will you be retired? In other words, how long are you going to live? Americans are living longer, healthier lives. You need to plan on spending at least 15 to 20 years in retirement. And remember, there's a strong possibility that you may have to spend upward of 25 or 30 years or more being retired, so your savings need to last. You will also need to plan for medical expenses. Medical cost inflation can quickly erode retirement savings. When trying to determine healthcare expenses in retirement, one of the places we want to begin with is Medicare. Medicare eligibility generally begins on the first day of the month that you reach age 65. If you're receiving Social Security benefits before age 65, you should automatically receive a Medicare identification card in the mail shortly before your 65th birthday. If you're not collecting benefits before age 65, you should enroll for Medicare about 3 months before you turn 65. Just because you're eligible for Medicare doesn't mean you should enroll and pay the premiums right away. If you're still working and your employer's plan offers adequate coverage and you can save money by not enrolling, you may want to wait until you retire. An extremely important point about Medicare is that you must pay close attention to the application deadlines and rules related to applying for benefits. If you enroll late or drop out and enroll again later, you may pay a higher premium for the same benefits. So now let's take a look at what makes up Medicare coverage. As you may or may not be aware, Medicare is broken up into several parts. Part A is known as hospital care, covers inpatient care in hospitals, inpatient rehabilitation facilities, and inpatient stays in skilled nursing facilities. Let me put an asterisk on that because we'll come back to that later. It also covers hospice care and some home health care services. You choose the hospitals and facilities you want to use. Part B helps cover medically necessary services from physicians, outpatient care, and some preventive services. As in Part A, with traditional Medicare, you select the doctors and other providers. Part C, known as Medicare Advantage plans, involves private insurance companies, HMOs, PPOs, that offer Medicare approved plans that provide the hospital and medical insurance under Part A and B. In most of these plans, you do not get to choose your doctors in the fact that you need to stay in the plan's network and use their doctors and hospital providers. Or in the case of a PPO, you may be able to go out of network but pay more. Part D is your prescription drug coverage. If you want this coverage, you choose and join a Medicare prescription drug plan from private companies approved by Medicare. Most Medicare Advantage plans, Part C, also include the Part D coverage. You may also want to consider what's known as a Medigap policy, which covers amounts that Medicare does not pay. These policies are offered by private insurers not affiliated with Medicare, and costs vary by level of coverage. One thing to note, you cannot carry a Medigap and a Medicare Advantage plan. You must choose one direction or the other. So let's talk about some of the costs associated with Medicare. For most people, you do not have to pay a premium on Part A by virtue of having worked 40 or more quarters of Medicare covered employment. If you haven't, the premium is $285 a month if your spouse worked between 30 and 39 quarters, and $518 a month if you've worked less than 30 quarters. Part B's premium ranges go from $202.90 to $689.90 per month, depending on your adjusted gross income on your tax return. For Part A, the hospitalization portion, the 2026 deductible is $1,736 for each hospital stay of 1 to 60 days. There are daily co-payment amounts for stays longer than 60 days. In a skilled nursing facility, the co-payment is $217 per day for days 21 through 100 for each benefit period. Under Part B, the annual deductible is $283. After you reach that deductible, you generally pay 20% of the Medicare approved amount for the services. Before we leave Medicare, I want to remind you to pay close attention to the deadlines for enrolling in Part B and or Part D. There are penalties for enrolling late, such as the possibility of having to pay a 10% higher monthly premium for enrolling late in Part B. For more information, you can visit the Medicare website, www.medicare.gov. So I had previously mentioned a Medigap policy. Medigap policy is a health insurance plan sold by private health insurance companies to fill the gaps in the original Medicare plan coverage. Medigap policies help pay some of the health care costs that original Medicare plans don't cover. If you are in the original Medicare plan and have a Medigap policy, then Medicare and your Medigap policy will pay both their share of the covered health services costs. Insurance companies can only sell you standardized Medigap policies. These Medigap policies must have specific benefits so that you can compare them easily. So previously I talked about skilled nursing facility and the copays and said we'll get back to that because that is not a nursing home. For example, if you break your hip and need skilled nursing to help you do physical therapy, 30 days, 60 days, that would be a skilled nursing facility. If you have dementia and can no longer feed or bathe yourself and need a skilled nurse to take care of you, that would be a nursing home. The average cost of a nursing home nationally is over $100,000 a year, though this can vary from state to state. So, why talk about the price of nursing homes? Well, because most people over age 65 will require some long term care services at some point in time in their lives. Contrary to what many people believe, Medicare does not pay for the majority of long term care services that most people need. Things like help with personal care, such as dressing or using the bathroom independently. Planning is essential for you to be able to get the care that you might need. So, how do I determine if I'm ready to retire? Well, let's go through some of the planning worksheets associated with this seminar to see if you are ready to retire. These worksheets include a format for you to record your assets and their value today, project their value 10 years from now, and how these assets might grow between now and then when we begin retirement. Another one enables to see how your assets might provide income over 30 years of retirement. There are also several worksheets to help you identify and estimate your monthly expenses of today and 10 years from now. There's also one that provides a comparison of income and expenses, which of course is critically important. The other worksheet outlines where you might need to accumulate additional savings in retirement before you're ready to retire to enhance your chances that your nest egg will last as long as possible. Now let's take a look at examples of these worksheets to show you how you can help grow and prepare and get organized for your retirement. One helpful item is the retirement timeline. This is a summary outline of the important dates as you approach retirement. Remember, if you do choose to start taking Social Security benefits at age 62, you will permanently receive this reduced amount. You should also go to www.ssa.gov to get a copy of your most recent Social Security statement to see what your benefit amount will be at full retirement age. Worksheet A can be used to help you list your assets in today's value of money. For Worksheet B, we can see the possible potential growth of these assets 10 years from now based upon the different projections you want to make. Worksheet C allows you to add new savings that you're going to make between now and retirement that you don't necessarily have listed in your assets already. Worksheet D is extremely important as it can help you budget in your retirement by projecting your monthly income over a 30-year retirement period. Worksheet E is to help you with your budget to see your income and expenses in today's dollars. Worksheet F will help you project those expenses out into the future 10 years from now. Worksheet G will help you with your future budget as it's projecting those income and expenses 10 years from now and comparing them. Worksheet H helps you identify any shortcomings in your retirement plan and help you prepare for those shortcomings. Here are some websites that you might find useful in helping you to prepare for retirement. www.aarp.org, that is the American Association of Retired Persons. Dinkytown.net is a variety of financial calculators and tools. SSA.gov is the official Social Security website where you can find and enroll for your annual statement. Medicare.gov is the official Medicare website where you can compare plans and doctors and tools. IRS.gov is the official IRS website, and PSCA.org is the Profit Sharing Council of America that also has retirement planning tools and calculators to help you prepare. Thank you for attending today's seminar. Please be sure to download the documents, including the checklist that goes with this seminar. If you'd like additional information or would request a free consultation, please reach out to us at jody.zellner@lpl.com, or you can go to our website, www.shfinancialadvisors.com, or reach us by phone 727-475-8490.